Hi everyone, welcome back to Finance 3000. In this week's lecture, we're going to continue our discussion about risk return. We know risk premium is the extra return risky asset has been earning as compared to risk-free assets. It is the extra return used to compensate for the extra risk. And we know if we denote the return from a risky asset as the capital R, and we denote the return on risk-free asset as RF. Risk premium is simply the difference between R and RF. When we talk about return, we need to make the distinction whether we are talking about realized return from the past or expected return for the future. It is return that we already had from previous stock market price realizations, or is it something that we are looking at to the future? Depending on which return we're talking about, we also have the realized risk premium, the actual difference between past returns and risk-free asset, and expected risk premium. The risk premium we expect to earn if we invest in risky asset, making expected return R, and we're making returns from risk-free asset RF. Okay, we make less of a distinction about the realized RF and expected RF because it's a risk-free asset. We pretty much know for sure what kind of return it's going to generate for us. For example, we know exactly what kind of return is from the treasury bill. There's no uncertainty. That's why the realized return can be the same with expected return because we know for sure. That's why we call it risk-free. But for risky asset, what's realized can be very different from what's expected. Okay, but when we are talking about the future, the expectations, we always need some basis to form this expectation. That's why we often use the average of past realized risk premium to make expectations about the future risk premium. We also defined the market risk premium as the difference between the return from a market portfolio and the return from risk-free asset. We often use risk-free asset as the treasury bill and the market return as the return from S&P 500 index. And we talk about that the realized market risk premium can be different depending on what time frame we have selected. If we have been looking at the average market risk premium all the way back from 1900 to 2015, we know the number is 7.6. Okay, if we're using all those periods from 1900 to 2015, from chapter 7 we calculated the average risk premium is 7.6. But depending on which subframe we're using, we can have either here is 7.1, correct me if I'm wrong, 8.8, and here is 6.1, and here we have 8.2, right? And they can be off a little bit, but on average, we're not too much off if we use 7% as the average realized risk premium from all the US market in the history. And then when we are ready to form expectation about future market risk premium, we can use this 7% number to base our forecast on. And if you're more optimistic, you're more risk tolerant, you might adjust this number down a little bit because you require less compensation for taking additional risk. But when we're making our forecast, 7% is a rule of thumb. Now we know enough to derive the famous capital asset pricing model. Let's take it step by step. We know the following for a fact. First of all, the return from any risky asset has two components. The first part, RF, is the compensation for time value of money, the compensation for waiting to delay consumption. The second part is the compensation for risk exposure. And here, risk, we only mean market risk, because only market risk can earn risk premium, can be compensated. Individual risk can be diversified away, thus cannot earn any risk premium. Okay? The two components for any return is risk-free rate plus risk premium. Okay, this is a return from any risky investment. If we're talking about risk-free investment, risk premium is basically just zero. The higher the risk, the higher the risk premium. Okay, we got the first part done. And then we know that when we are talking about the market risk premium, we are just thinking about the market as a whole as represented by a market portfolio, the S&P 500 index. And the market risk premium is a compensation for a 100% exposure to market risk. Because when you are holding the S&P 500, you are having a one-on-one relationship with the market because you're holding the market itself. So you have 100% exposure to the market risk. So the market risk premium is simply the difference between market return, RM, and risk-free return. The market risk premium is the difference between RM and RF. Okay, and this measures 100% exposure to market risk. And we also know that the beta is a measure for the relative exposure to market risk. Your beta is the percentage of market, the fraction of market risk exposure you have. If you have a beta of 1, you have 100% of exposure to market risk, right? Beta equals to 1 is 100% exposure. If you have a beta equals to 0.5, you have a 50% exposure to market risk. When the market is up or down by 1%, you are up and down by 0.5%. And then when we try to measure the risk premium for any risky asset, we can simply have this beta, the fraction of exposure to market risk, times the market risk premium. Okay, so the market risk premium is the compensation for 100% of market risk, and beta is a fraction of your exposure to market risk. So beta multiply market risk premium is your absolute exposure to market risk, okay, for any risky asset. This is a really crucial, important concept. And then we can combine everything together. We have this R, the return from any risky asset, equals to RF here, okay? It's two the same, plus risk premium. And the risk premium for this risky asset is simply beta times market risk premium. And market risk premium is RM minus RF. So here is the risk premium from this individual asset. Okay, and now we have the capital asset pricing model. This is how it is derived, and we understand how it came from, where it came from. With the CAPM, we have the tool to calculate the expected return for any risky asset. As long as we know what is the risk-free rate from the economy, what is this risky asset's beta, and what is our expected risk premium from the market. Okay, those are pretty easy to get numbers, public information, and we can calculate the expected return for any risky asset, and we can use the expected return as the opportunity cost of capital in our valuation models. Let's look at one example. Suppose the expected return on the stock market is 10%. Okay, this is our RM, expected return from the market, and the risk-free rate is 3%. Or it can tell you the treasury bills return is 3%. It's equivalent. RF. What is the risk premium for a stock, which is a risky asset, that has a beta of 0.5? Okay, now we know the beta. What is the expected return of the stock? It's asking for the R. Right? So we know the market risk premium is a difference between RM and RF. 10% minus 3% is 7%. Then the risk premium for any risky asset is beta times the market risk premium. 0.5 times 7% equals to 3.5%. Make sure you know how to convert between decimal points and percentages. And then the expected return from this risky asset equals to RF, 3%, plus the risk premium from this asset, which is 3.5%. And now we have 6.5% as the expected return from this stock. We can see that this expected return is lower than the market return. Why? High risk, high return. You have a beta less than the beta for the market, so you're taking less market risk. You can only ask for a lower expected return. Okay, and this CAPM relationship we have here, R equals to RF plus beta RM minus RF. Okay, we can see that the relationship between return and risk. Return and risk. And we know that beta is a measure for market risk. So the higher the market risk, the higher your exposure to market risk. The higher your beta, the higher your expected return. High risk, high return. Okay, now we know that the higher the beta, the higher our expected return. But not all of us want the same level of risk in our portfolio. For one thing, we might have different preferences for risk. I might be a highly risk-averse individual, and you might want to take more ride with the market. And for purpose of portfolios, different portfolios have different customers or investors. For example, pension funds. Typically, the portfolios from pension funds have a lower beta than the portfolio from hedge funds. Both are diversified portfolio, but intentionally they have different betas. Well, then how do we adjust our beta from our portfolio? From previous class, we know there were several ways we can adjust our beta. We can either construct a portfolio of low beta stocks. If we want a low beta portfolio, we can just have 20-30 stocks all have low beta. And the beta of a portfolio is simply the weighted average of the individual stock, right? So that we can simply just have a bunch of stock with low average beta, so we're good with low beta portfolio. On the other hand, we can have a high beta portfolio by having 20-30 stocks have high beta. Okay, that way we have constructed a high beta portfolio. Another way to do it is to buy those pre-mix high beta mutual funds or low beta mutual funds, by pension funds, even by bond funds. They will have even lower beta. And the CAPM also gives us another way of constructing a portfolio of different beta while achieving full diversification, right? And this is our next topic. We know that the market portfolio, which represent every asset in the market, should have achieved the optimal diversification. Okay, the optimal diversification, because we cannot go beyond the market portfolio. We have included all of the asset in the portfolio, theoretically. And well, we know that with 20-30 stocks, we are pretty close to optimal diversification, but theoretically, only the market portfolio gives us optimal diversification. And then if we want to maximize the benefit of diversification, all of our rational investors should invest in the market portfolio. But we know that the market beta is 1. Then how can we adjust our beta if we don't want a one-on-one relationship with the market? We want more aggressive, with more roller coaster up and downs, or we're more risk averse. And remember, we have another asset in the market, which is a risk-free asset. The beta for risk-free asset is 0. Why? That's why it's called risk-free asset, because it doesn't move with the market. No matter how high the market return is and what the S&P 500 is doing, Treasury bill have the same return. They have a 0 correlation with the market. That's why we call it risk-free. And then with one asset have a beta of 0, the other asset have a beta of 1. If we just hold a portfolio of those two assets, we can achieve any beta between 0 and 1. Because remember, the portfolio beta is simply the weighted average between the two assets beta. If we only have the market index as one asset, the Treasury bill as the other asset, we match and mix the proportion between the two, we can achieve any beta between 0 and 1. If we want to achieve higher than 1, we can borrow money to buy additional market portfolio. Okay, and we typically cannot have a beta less than 0 unless we go short. Okay, we go against the market movement. That's one possibility. Let's see how it works in the following slides. Okay, it looks like a lot of information from this table, but really I'm trying to illustrate one simple idea, that the beta of your portfolio is simply the proportion you put into market portfolio. Let's see how it works. So here we have risk-free asset with a beta of 0, and the market portfolio has a beta of 1. We already know that. The return from the risk-free asset is denoted as RF. The return from the market portfolio is denoted as RM. And if we have a portfolio and we hold only risk-free asset and market portfolio, the proportion of wealth of our portfolio is put into the market portfolio denoted as Y. So 1 minus Y is the rest of our proportion devoted to risk-free asset. Okay, 1 minus Y plus Y equals to 1. And the portfolio with Y proportion invested in market portfolio and the rest in risk-free asset will have a beta of the weighted average between risk-free assets beta and market portfolio's beta. Okay, so we have 1 minus Y multiply 0 plus 1 Y minus 1. And the beta of our portfolio is Y, which is equal to the proportion we put into the market portfolio. Okay, we got the first part down. And then if we want to calculate our portfolio return, our return is simply the weighted average between the two returns in our portfolio. The two assets in our portfolio is risk-free asset and market portfolio. Their weight is 1 minus Y and Y respectively. So we arrange terms, put this RF out and put this minus sign inside the bracket. We have R equals to RF plus Y times RM minus RF. Okay, exactly the same way with beta. The expected return from any well-diversified portfolio will equal to RM times beta times the market risk premium. And this equation is called the capital asset pricing model. The beta is the proportion that you put into the market portfolio. The takeaway from this whole table is that if we invest all of our wealth in risk-free asset and the market portfolio, this is only two assets we choose between, our portfolio beta will equal to the proportion of wealth invested in the market portfolio. Okay, here we know that if we are lazy, we don't want to analyze the stock market, and we don't even want to choose a mutual fund because we don't know which one is a good fund manager and which one is not. And also from Chapter 7, we know that mutual fund managers typically do not beat the market. So why not just be passive, invest in the market index and then the treasury bill? We know for sure that we have achieved full diversification and we can adjust our beta of portfolio, our risk exposure, just by adjusting the weight in the market portfolio. That is a really easy way to invest. And actually, this is the way I have been investing our family portfolio for ever since I have started investment. Okay, and if I think the market is doing well, I just adjust the beta up a little bit. How do I do that? By selling some treasury bills and buying more of the spider. And if I think the market is going down, I want to be more risk averse. I reduce my exposure to the market risk by adjusting down the beta, selling some of the spiders and buying more of the treasury bill. That's a really easy way to investment, and actually that's the way that I recommend you do with your living money, not play money. We mentioned in the GameStop slide presentation that you could have some play money that you can risk losing. And you can put those money into testing your new ideas in the financial market, following some trends, and just to test the water. But with your living money, you need to be really cautious and make informed decisions about your investment. Don't do anything you don't understand yet. Example, suppose the treasury bill return is 3%. Market risk premium is 7%. Note here that they told you the market risk premium. Okay, this is already RM minus RF. And we invest 20% in market portfolio and 80% in treasury bill. What is the beta of our portfolio? What is the expected portfolio risk premium? And what is expected return? The beta of the portfolio, as we know, is simply the weighted average of the individual betas of the assets in the portfolio. The proportion in the market portfolio is 20%, and the market beta is 1. The proportion in T-bill is 80%, and the beta of the T-bill, as we know, is 0. So we have this equation here, and we find out that the beta is basically the proportion we invested in the market portfolio. Okay, we can even answer the question without even calculations. Expected risk premium of the portfolio. Expected risk premium of the portfolio can also be calculated by the weighted average of the risk premium from the two portfolio. Similarly to the return of the portfolio can be calculated as a weighted average of the returns. Only standard deviation cannot be calculated as the weighted average because of diversification. Okay, we have 20% of the risk premium from the market, 7, and 80% of the risk premium from the risk-free asset, 0. So we have 1.4 as the expected risk premium on the portfolio, who has a beta of 0.2. And then the expected portfolio of returns following the CAPM equals to RF plus beta times the market risk premium. Okay, so the only caveat from this type of question is to understand what they have given you. If they have given you the market return RM and the risk-free rate RF separately, you have to subtract RF from IM before you get market risk premium. But if they already given you the market risk premium, it's already the difference. Don't make the mistake of reading the question wrong and subtract another RF from this already risk premium. That will lead to mistake. Now let's summarize the capital asset pricing model, CAPM, and how it help us to complete our picture for the pricing model. The CAPM model provides a framework to form our expectation about the expected return from any risky asset or portfolio of risky assets. Basically, it helps us to make the R that we need in our pricing model. And we can use the R as a discount rate for any future cash flows that is involved in a financial asset. And then we can discount the future cash flows using the R back to the present to get the present value of the financial asset, which should be the intrinsic value or the fair price. Okay? And for the CAPM, we only need to know what is the market risk premium here. And typically we use about 7%. Or from another market, we can use a different number. And the beta from this financial asset, this risky asset, can be estimated using linear regression or the slope function. And the risk-free asset return can be looked up from the Treasury Department or generically any financial news portal. Okay, and then as long as we have all this information with us, we can form expectation about this expected return. And we use the expected return as our opportunity cost of capital in the pricing model. A cash flow happening at time t will be discounted by 1 plus RT times to get the present value. And no matter what kind of future cash flows is involved in a financial asset, we can always discount them one by one back to the present after we have forecasted the future cash flow. Now with CAPM, as long as we know the beta of some risky assets, we can calculate the expected return from the risky asset, right? We know that this expected return R is always equal to RF, risk-free asset return, plus beta times the market risk premium. Okay, as long as we know what is CRF, what is market risk premium, which are all public information, we can calculate the return, which is a linear equation. And then let's look at this linear equation again. What else does it tell us? Well, if we see the R as, for example, we denote it as Y. Later you will know what I'm going for. And we can write RF as say like A, just any constant. And then we plus B. We denote this RM minus RF equal as B. Okay, this is A, this is B. Hold on a minute, you will know what I'm going for. And beta, we denote it as X. What does it look like for us? this is a linear equation, right? And if we plot this linear equation on a graph with y-axis and x-axis here, and we know these two are constants. When x is equal to 0, this is a, right? And because it's linear, and the b is simply the slope of the line. Okay, and this line is called the security market line. It's basically a name for the CAPM on graph when we treat beta as x and r as y. And when x equals to 0, beta equals to 0, we have this cross with the y-axis, which is RF, right? When beta is 0, the return is risk-free return. And the slope is simply the market risk premium, the slope of the line. Okay, and why do we need a line like this? What else does the line tell us? It must be a reason that we're drawing this line, although it's very simple, it's a linear line. Well, this line basically tells us what should be the expected return for any risky asset, as long as we know the beta. Assume we have a treasury rate of return at 3% and the market return of 10%. And then we know the market risk premium is 10 minus 3, which is 7%. This will be the slope of this line. And when a stock has a beta of 0.5, we can directly find their expected return on the security market line. Okay? Because if we have 3 plus 0.5 times 7, we have 6.5. And this is expected return from this portfolio X. And with a portfolio Y, with a beta of, it could be a stock or a portfolio as long as it's a beta of 0.2, we have 3 plus 0.2 times 7, which is the difference between RM and RF. We have here 4.4. Okay, and the security market line tells us that the expected return of all securities and all portfolios must lie on this line if CAPM is true. Okay, let me repeat it. The security market line shows how expected rate of return depends on beta, and according to the capital asset pricing model, expected rates of return for all securities and all portfolios must lie on this line. Why? Okay, we have to discuss why. Well, this has everything to do with the previous really important concept we had, the law of no arbitrage. A lot of important results from the financial markets come from this law of no arbitrage. The textbook didn't mention it because it's a grad school level concept, but it's underlying a lot of really important results we have. I wish we had more time to just dig into this concept. Because if you stay away from this concept, there's no really good understanding of a lot of the results we talk about in class. Let's see how it works. How does all asset return must lie on this line? Suppose we have a common stock which has a beta of 0.5. And if it has a beta of 0.5, on the security market line, it will have an expected return of 6.5. Okay, just as previously we calculated. If I have a 0.5, RF is 3%, RM is 10%, it must have a 6.5% return. What if it doesn't? Okay, what if it's on top of the security market line or below the security market line, meaning that their return can be higher or lower than what the security market line describes? What happens in that case? For example, if we look at this X double prime first, if the stock offered lower rate of return than what is according to the SML, meaning that it plots under the security market line here. Okay, if you think about it, if you are asking us to take the market to risk, which is equivalent to 50% of the total market risk. Beta equals to 0.5. And you're providing us with a lower return than what we can achieve by holding half and half between risk-free asset and the market portfolio. Because if we hold half and half in market portfolio and risk-free asset, our portfolio will have a beta of 0.5 and we will get a 6.5% return. And if we are having the same risk exposure but having a lower return, as a rational investor, this is not a good risk-return trade-off. We can do better. So we'll always go to the better asset, which gives us a higher return, but on condition on the same risk. Okay, so what happens when no one wants a financial asset? Its price is going to drop. What happens when when demand drop, price is going to drop with the same supply. Basic law of supply and demand. When price drop, what happens? Your investment drops and return increases. Because return is basically the money you can make per dollar of your initial purchase price. And when the return goes up, it drives this X double prime back to X, back to the security market line. And that's why it cannot plot under the security market line. And what if the demand keep going down and the price keep going down, the return keeps going up, it goes all the way on top of the security market line? What happens? If a stock offer higher rate of return, it plots over the security market line, for example at X prime, okay, with the same market exposure, with the same risk exposure, is offering us a higher return than our portfolio of half and half in market portfolio and risk-free asset. Then as a rational investor, we will all go buy it because it's a better risk-return trade-off. This is an arbitrage opportunity. Okay, so when we buy it, what happens? When we all want to buy this X prime, the demand goes up, the price goes up, and the return goes down because it's more expensive to invest in this asset. When the return goes down, it drives the X prime all the way back to X. Because if it drive any further, go to X double prime, the market force is going to force it back on. So because of this market force, because of rational investors always looking for arbitrage opportunities, the investors will only buy asset with returns on the security market line. And the security market line is an equilibrium result. Equilibrium means after all the market forces has cleared, when the market doesn't move anymore. Okay, and this is a really important result from the CAPM. As long as the CAPM is correct, as long as we can write any financial assets expected return as RF plus beta times RM minus RF, as long as this equation is true, all securities equilibrium return should lie on the security market line. Note that I emphasized many times if the CAPM is correct. Then let's talk about whether the CAPM is really correct. First of all, when we are testing a financial theory, we have to test its conclusions. So what does CAPM tell us? What is the CAPM conclusions? CAPM tell us several things. First, it tells us that only beta matters in terms of calculation for the expected return. Why? Expected return equals to RF, nothing we can control, plus beta times market risk premium. Both of those two factors are out of our control. And they're the same for all assets. Only the beta is different for each asset. Then CAPM tells us that as long as two assets have the same beta, they must have the same expected return. That's the first thing that the CAPM tells us. The second thing that the CAPM tells us is that return is increasing with beta. The higher the beta we have, the higher exposure to market risk, the higher expected return we require in order to be compensated for the higher risk. Okay, and if CAPM is perfectly correct, this is the security market line we have. And this line we just described in the previous slides can plot any returns from the market, whether it's risky, as long as it's an asset. It can be risk-free, it can be risky, it can be a portfolio, or it can be an individual stock. And here we have expected return, not realized return, because realized return can have a specific risk or have noises, and this expected return. Okay, now let's test it, whether CAPM is correct. How do we test it? Okay, we form a portfolio of different betas, and we see how does the different portfolios performed over the past. If the average from past historical returns can be used as the expected return, then we are testing the CAPM. Okay, and people actually did it. Here on this chart, we have 10 portfolios. Those 10 portfolios have different beta. So the portfolio 1 have the lowest beta, the portfolio 10 have the highest beta. According to CAPM, we have calculated the average risk premium from these portfolios, okay? On the y-axis, it's all the R minus RF on the y-axis. And on the x-axis, it's the beta. If CAPM is correct, those orange lines should have lined on the security market line here. But the orange line is not lying on the security market line. It's actually, if we connect this orange line, it's actually flatter than the security market line, but it's still increasing monotonously, meaning that the higher beta did give the average higher risk premium, although it's not as high as what the security market line describes. So we know that the CAPM is partially correct because it does tell us that the high beta portfolios have a higher risk premium than the low beta portfolio. So higher return is compensating for higher exposure to market risk. Market risk is monotonous with the return, but it's flatter. It's not as much. The compensation is not as much. So we know that the second conclusion from CAPM is correct. Well, we have one strike against the first prediction. Not only beta matters. This discrepancy between the actual line and the security market line must be because some other factors not captured by the CAPM still matters. And what could be those factors? What could be mattering other than the market risk? People have found two. One is value versus growth, and the other is size. Okay? The two factors other than beta, which matters for returns. Okay, how did they find that? Well, look at this chart. On the y-axis, this is dollar with logs there. Basically, that's 0. Okay, log 0 equals to 1. So the y-axis is 1. And the year. So how does it? So basically, they have find two portfolios with the same beta, and one portfolio have high book-to-market ratio, and the other have low book-to-market ratio, and they short the portfolio with low book-to-market ratio, and they long or buy the portfolio with high book-to-market ratio. If CAPM is correct, only beta matters. The two portfolio with the same beta will have the same return, although they have different book-to-market ratios. Then this blue line should be flat, should always be here, if CAPM is correct, because there shouldn't be any return differences given the same beta. But this is not true. Actually, we found that the higher book-to-market ratio portfolios is earning a higher return than the low book-to-market portfolio. That means value matters. If we had been investing in value stocks rather than growth stocks, we would have made money even though the two types of stocks had the same beta. So there's a value premium. Value stocks on average is giving us higher return even if the two types of stocks have the same exposure to market risk. Not only market risk matters. Similarly, if we have bought small stocks and sold big stocks with the same beta, we would have made money over the years. That means not only beta matters, the smaller stock have a premium over big stocks, although they have the same exposure to market risks. Okay, so we have to find two factors other than beta, other than exposure to market risk, that matters in expected return, or at least in average realized return. One is size, and the other is book to market. Okay? And people have factored into this two additional factor into another really popular pricing model, which is the Farmer-French three-factor model. The Farmer-French three-factor model basically tells you that expected return equal to RF plus the first beta is still the beta for CAPM on market risk premium. The second beta is on size, or small minus high, large, big, okay? And the third beta is on book to value, or value minus growth, or high minus low. Okay, and this is just for your knowledge. It's not going to be tested. And there have four factor models if you add momentum. Okay, beta 4 is momentum. And if you look into the literature on pricing models, basically nowadays every hedge funds, every asset manager is going to have their own pricing model for R. Does that mean beta is dead? Does it mean that CAPM is no longer useful? No, absolutely not. Because CAPM remains the most used model. And everybody is building their own model on top of CAPM. You can add a bunch of factors you think is important other than the market factor, but no one disagrees that the market factor is still very, very important. Arguably, it's still the most important factors in the pricing models. Okay, and our takeaway for Finance 3000 will be here, that CAPM, although it's too simple to capture everything that is going on in the market, still captures two fundamental ideas in finance. First, investors require actual return for taking on risk, especially market risk. And second, investors are concerned principally with the market risk that cannot be eliminated by diversification. Okay, and if you're interested to see exactly why CAPM is too simple or CAPM doesn't fit the data perfectly, well, they argue that if you're testing a theory, you have to think whether we have satisfied the conditions for the assumption from the theory. The CAPM poses a lot of assumptions. For example, that we're actually using the market portfolio, but in reality, we're using the market index to represent a theoretically market portfolio, which includes all of the risky assets in the market. This is an approximation in the first place. And then CAPM, all the results projections is about expected return. But here when we're testing it, we're using historical realized return. And then the question becomes whether the realized returns are actually good predictions for the expected return. Okay, and those arguments is too theoretical, too academic for our purposes. And our takeaway will be that CAPM is still useful, we still use it, but we adapt it accordingly, and then it gives us some fundamental ideas that is still very true and very relevant in today's stock market. The CAPM tells us that after we have estimated the beta for a stock using linear regression, the stock price, the stock returns, we know their exposure to market risk. And then we can use the CAPM to calculate the expected return from those stocks. And what does the stock expected return tell us? The expected return is also the cost of capital from these companies, the cost of equity capital to be precise, because we're using the beta is using the stock market information to estimate. This is exposure to market risk. And the cost of equity capital tells that if an investor is willing to invest in US steel, which has a beta of 1.85, it is requiring a return of 16%. Because according to CAPM, any risky asset with a beta of 1.85 should yield a fair expected return of 16%. Only if US Steel can offer this 16% return will any investor be willing to invest in US Steel. So this is becoming the R when the investors is calculating the present value of US Steel's price, right? They're using future cash flows from US Steel discounted by the 16% to calculate the present value, how much money they're willing to give US Steel if they issue additional equities today. And this is a cost of capital. When US Steel, from the financial manager's perspective, when they are ready to raise equity capital, they also do the same thing, that they calculate what is the required capital, what is the expected return, what cost of capital from equity investors. And this is their cost of capital, meaning that they need to repay the investors 16% in order to raise the amount they can raise today. Okay? And when they're doing capital budgeting, they want to see how much risk they're taking in a specific project and how does that factor into their beta, and how much capital, what is the opportunity cost, what is the return they have to promise their investors. And we know that those betas are the average beta for the company's different projects. We can think about company as a bunch of projects. Okay? A company is basically just a portfolio of projects. If I'm Apple Computer, I'm a portfolio of my iPads, of my iPhones, of Mac, of the different educational projects that I have on the market. But each project will have a different risk. And when I'm calculating my overall beta, it's a weighted average of all the project risk. But if I'm raising capital in the financial market, the investor cared about where I'm putting the money. Exactly where I'm putting the money. Not only how much beta my company overall have, but where does the money go to? How risky is the money? What is the project beta? That's why we want to make a distinction about the project beta with the company's beta. The project cost of capital depends on the use to which the capital is being put, not only what is the average beta of the company. Therefore, it depends on the riskiness of the project and not the riskiness of the company, which is the average across all their projects, especially when the company is having new projects in new industry, which have a very different risk profile than their other projects. So we need to distinguish between the company's cost of capital and the project cost of capital, because the company's cost of capital is only suitable for any project which is assuming the average risk across all investment projects undertaken by the firm. Okay, let's look at one example. The risk-free rate is 4%. The market risk return is 14%. Based on CAPM, this company have a cost of capital of 4 plus beta 1.3. Okay, here I think we forgot to mention the beta is 1.3 times 14 minus 4 risk premium. A breakdown of the company, which equals to 17%, is the company's cost of capital. A breakdown of the company's investment projects listed below. When evaluating a new dog food production investment, which cost of capital should be used? We know that 1/3 of the ABC company's business is in nuclear parts manufacturer, which has a beta of 2.0. And 1/3 is a computer hardware drive, which has a beta of 1.3, and 1/3 is from their new business venture dog food production, which is a more defensive industry because you gotta feed your dog no matter what is the economic condition. But you can hold back from computer hardware drive and nuclear parts manufacturer at a beta of 0.6. And if we want to calculate the company's beta, we find out that the beta of the portfolio is a weighted average of the beta from each individual asset, which is 1/3 times 2 plus 1/3 times 1.3 plus 1/3 times 0.6, which is equal to 1.3. This is the overall company beta. Then, when we are using the company's beta to calculate the company's cost of capital, we have 10%. Okay, RF plus beta times the risk premium. This 10% reflects the opportunity cost of capital on an investment given the unique risk of the project, which is the average risk from the company. But when we're evaluating a new dog food production investment, shall we be using this previous 17% or this 10%, which is using the dog food beta, okay? The dog food from the beta from the dog food production. Well, we should be using this 10% because this cost of capital is reflecting the risk of this new project, the dog food production investment. If we will be using the 17% cost of capital from the company, we will have overestimated the risk from this investment. And then we will be overestimating the cost of capital, underestimating the value of this investment. Another example, suppose Walmart is planning an internet subsidiary to compete with Amazon. It says that it can compete aggressively because it have a lower beta. Walmart does have a lower beta than Amazon. And its shareholders using the lower beta can find out that the cost of capital for Amazon is only 5.6%. And Amazon is arguing that they're only going to pay 5.6% return to their equity investor in order to raise capital to invest in internet to compete with Amazon. If you are a potential investor from Amazon, from Walmart, are you going to be satisfied? Are you going to be happy? No, of course, because we know that if you are going to the internet industry, internet retail, you are facing very similar risk with Amazon. Then your low beta no longer applies to the new project. You should be using a beta that is very similar to the Amazon beta. And that's going to push up your cost of capital to way higher than 5.6, and that's going to give you a lower present value of your future equities. Okay, and if we had used this 5.6%, we will have overvalued the project. If we did that, we have overvalued the project. Okay. All right, that is everything we have from chapter 12. We talk about what is a measure for market risk, is beta, and how to calculate the beta of a portfolio, which is basically a weighted average of all the individual beta. And then we derived the capital asset pricing model. We formally connected the relationship between risk and return. We had a discussion about the ups and downs of CAPM and the limitation of CAPM, but we concluded that the CAPM is still very relevant in today's stock market.